Adam and I met, I think, like what, 10 years ago. Both our wives were in the same mom's group, and I got to know Adam through that. And then, Adam, you've been financial advisor the whole time I've known you. Um, and I think you were a couple years, like what, 2, 3, 4 years in when we met.
Yeah, 2011.
Okay. Yeah. So Adam's had a lot of success very, very quickly. He really impressed me, when I went in and met with him at his office, just the knowledge he has with things that I haven't heard from other financial advisors. And we just kind of hit it off that way and got to know each other over the years. And he's been a great, referral partner for some clients back and forth. And he's given me great advice, to help my clients out, give me great advice personally, different, investments for tax strategies, things of that nature. So I wanted him to talk this morning and share, some things that can help out, the realtors and loan originators that are on the call with their clients, with like retirement accounts, investment accounts, like what are the rules with pulling funds out, what are the tax implications, what are the time frames, can you pull it out of IRA for 60 days and put it back in without any penalties, and just talk about Adam, you had the you have the Roth IRA that you told me about over the years. And then like if you make a certain amount of money, there's a Roth conversion you can do if you make over the income limit. So just kind of hit on some of those things.
Yeah, sure. Thanks, Sean. So I've met a lot of you before. I think I've done one or two of these talks prior, so I see a lot of familiar faces. But so today I'll talk more about how can you find money for your clients, whether you're a loan originator or realtor, and what are some rules from the IRS, and what are some areas that you can go and pull money from in case someone wants to refinance or if they need to buy a home, whatever the case may be. So I'll bring up a slide. All right, so just a real quick background on me. Again, a lot of you know I came from the restaurant industry before 2011 when I started in the financial services industry. I was the managing partner of Capital Grill. If you want to talk wine, I get super geeky on you because I still have that sommelier background and training. It was my birthday yesterday, and the team actually did, for my birthday during lunch, a blind tasting to see if I still had the skills. And happy to say I was still able to identify the wines, and it was fun. But anyway, so started Taylor Financial in 2018. After 7 years with a larger institution, decided to go on my own. I'm a Florida State alumni, born and raised in Tallahassee, been in Tampa since 2009, but been winning the Similar 100 Award, which is the fastest growing businesses in the United States owned by a Florida State alumni the last 6 years in a row. And then the Tampa Bay Chamber loves us for the kind of unique planning and service and concierge level mentality we have. And so they've given us some awards. We haven't won them yet, but we keep getting nominated, which is great. And then, of course, you may be able to see behind me or even in my name, I'm a dork and I have a bunch of degrees and designations. So I continue to take tests because I don't know, I just like taking tests. And I think the knowledge obviously not only helps confidence, but also helps to steer our clients in the right direction. So here's our team. We have a team of 13 people. A lot of you have met them before, but we have 5 advisors and then a support staff that really helps to tackle all that. Some of you may have seen the building. We have a beautiful building on the corner of Dana Shores and Memorial. That's a picture before they took the little supports off the beautiful royal palms there. I'm obsessed with AstroTurf. It's so easy to mow your yard just with a blower, which is kind of cool. And then, so here's us. So we have clients all throughout the nation, not just in Florida, all throughout the United States. I think we're actually up to 27 or 30 states now. But we provide financial literacy, which I'll talk a little bit today. We'll do risk management. So any of the life insurance, disability, long-term care, retirement planning is really where we thrive when it looks at distribution planning, portfolio analysis. So a lot of the revenue, majority of it comes from the investments that we do, as well as the distribution strategy. So a lot of different services. We do have now an in-house tax firm. So they're literally on the other side of this wall. So if you need clients need bookkeeping, if they need tax filing or tax strategy, and then we have a partner on the estate planning side. So if you need wills, living wills, all the estate planning documents, we can help there. So this is all we do. I'll send this slide to you, but I really just touched on that. So I'll skip this slide. and really just want to talk about some of the industries that we work with. We do a lot with business owners, a lot in the construction industry, former military defense contractors, and those approaching retirements. So that's really where we thrive quite a bit of the knowledge, and just really we spend a lot of time with clients in that area. Okay, that's all from the business side. I want to talk about first-time home buyers. Some of you may already know this, but according to HUD, a first-time home buyer is someone who hasn't owned a principal residence for a 3-year period ending on the date of purchase of a new home. And that's going to be important for IRA rules on how you can get to $10,000. So I want to touch base a little bit on that. Or an individual who's never owned a principal residence, even if a person's spouse was a homeowner. So if there's a divorce and that spouse wants to go buy a home, they could qualify for a first-time home buyer. Any single parent who previously owned a home with an ex-spouse, displaced homemaker who owned a property with a spouse. So again, there's that 3-year rule, or we want to think of, if you need to pull money from an IRA, you can get to it potentially if you've already bought a home prior. Let me stop there. Any questions so far? And I'll go into really how we can find some money. Perfect. So here's how you get to some money. So IRAs, a lot of clients have rollover 401ks into IRAs, and we can get to $10,000 for that first-time home buyer pretty easily, just depending on their situation. The downside is the funds cannot be put back in. So just making sure you work with your advisor to see if that's going to make a long-term impact on your overall financial plan. You don't have a 10% penalty fee, but you do have taxes on traditional IRAs. Unique thing about Roth IRAs is, if you remember, you fund a Roth with after-tax dollars, it grows tax-free. But if you have a Roth IRA, you can get to the contributions without any type of penalty fee or taxes. So it's a nice way to say, hey, I've got some cash in a Roth. I've had it for a little bit of time. I put 20 grand into it or 100 grand into it over the years. It's grown to X, but you still have the option to get to your principal and your contribution. So not a lot of people know that, but it's a nice opportunity to be able to get to cash if needed. Questions, comments, concerns on IRAs?
Is there a rule? So I had a borrower once that they were selling their house after they're buying a house, and I think it was I don't know if it was a regular IRA or a Roth IRA, but like if I remember correctly, I thought they had 60 days to put it back in to where it didn't affect them negatively. Does one of these fall into that rule?
Yeah, so that's a rollover IRA. So let's say you have an IRA at Raymond James, or you have a client that has a IRA at Raymond James, and they want to sell their current home to get into their new home. Well, they may be able to do that within a 60-day period. So if they have that IRA over at Raymond James, they can potentially, let's say, roll it over to us at Taylor Financial or any other institution. And what happens is you have 60 days to be able to get the money into that IRA. So they can have a check cut to them directly for the benefit of. They can cash that, use those funds, and then they can contribute that amount that was on the check to the IRA as long as it's done within 60 days. So it can be a little risky because of the timing aspect, but yes, Sean, you're correct that you can do a rollover IRA and have liquidity for roughly 60 days.
Awesome, thank you.
Is that 60 calendar days or business?
Calendar days.
Calendar.
The other one is the inherited IRA. So a few years ago, they changed this. It used to be you had to take out the money over either your lifetime, life expectancy, or over 5 years. They've pushed that back to 10 years, and you can do a lump sum too. Where that's important is that if you have clients that unfortunately had someone that passed away, a spouse or a father or mother, then they may have inherited IRA options to where they can get to money without a 10% penalty fee. Now, of course, they'll have taxes on it if it's a traditional IRA, But again, we've had some clients say, hey, I need to get the cash quickly, and I don't want to get hit with this 10% penalty fee because I'm under the age of 59 and a half. Well, then we can do that. Just saw some of the chats. Yes, you can get a copy of this. Yes, we'll be uploading. Oh, cool. Even better. I guess you're recording this. Okay, so that's IRAs. A lot of clients recently have been using brokerage accounts and lines of credit. So Sean has talked about this before with some clients, but you can use your non-retirement, called a non-qualified investment account, as collateral to get a line of credit. So let's say you've got $100,000 or $200,000 in an investment account. We use Goldman Sachs, we use Nationwide, we use certain banks that will look at their investment account, look at the risk tolerance of it. If it's all in fixed income or bonds, conservative, they may get a higher percentage from a line of credit. If it's all in Tesla stock or some type of individual equity or a ETF, well, then it may be a smaller percentage. But in this case, if they had $100,000 line of credit, or excuse me, $100,000 investment account, they could potentially get to 50 to 75,000 without having to sell their stock and get hit with taxes or gains or loss or any of that. So that's been extremely attractive for all clients. There's no fee to set that up. There's no credit check. There's not. It's very easy to set up within a matter of days, and it's a great way to get to cash if you don't want to get hit with gains or losses on your investments.
Much quicker than somebody doing like a home equity line. So we have buyers that are like, potentially going to sell their house after they're going to buy their house, or they don't have the, funds to be able to put down. This is a quick way. I mean, I think you got me approved for mine, and it was fast. I mean, it certainly wasn't 30 days. I mean, it was I feel like less than a week.
Yeah, it's 3 business days to get that set up. So if they don't have it invested with us, that can be a challenging, but we can always move over their investment account in kind, which means we don't sell off positions, because we act as fiduciary. So we can do any type of investing for our clients, and we have to do what's in the best interest for them. But we can move over their investment account, maybe at another institution in kind, no fees, no taxes, and then immediately set up a line of credit. So that if we move over from another institution, that's probably a week and a half, 2. If they already have funds with us, it's 3 business days.
And hear him saying there's no closing cost to it. It's fast, and the interest rate is very close to what a home equity line rate is going to be.
Yeah,
right
correct.
around prime.
Yeah.
And what's the term look like on those?
You can pay it back. You can keep it. I mean, it just depends on. There's no penalty for paying it back. Gotcha. Immediately or within a short period of time. There's none of that.
It's interest only too.
That is correct. Any other questions on the brokerage investment accounts? Okay, so 401ks, if they are employed as a W-2, they may have a 401k. And a lot of plans these days will allow for loans. You can get to 50% of the value of your 401k, or a maximum of 50,000. You're not taxed on that. And there's no 10% penalty fee for taking them out before the age of 59 and a half. The loan is usually, it has to be paid back in a 5-year period, and it's typically interest free. So it's a great way to be able to get the cash if you need it in a short period of time.
Hear him say loan. So the loan, you're paying it back to yourself. There's also a hardship withdrawal option. You want to hit on that. That's not the best option a lot of the time, doing the hardship withdrawal.
Yeah, I mean, if you can prove that there's financial hardship, or if there's some type of disability, or there's some type of and there's actually even been for COVID, if you remember a few years ago, that was considered an emergency. So people could get to funds of their 401k during COVID or some type of emergency situation without having to pay a 10% penalty fee. Now, granted, when you go to take that, you may be taxed if it's considered a hardship withdrawal. or some type of withdrawal that qualifies as an exemption.
For purpose of buying a house, if they did a hardship withdrawal, they have to pay taxes on it, but do they have to pay the 10% penalty if they're
I was
a
just gonna
first time home
ask
buyer? Okay.
You're correct. Yeah.
They,
So
they
that-
would?
they would not have to pay a 10% penalty fee if they qualify for one of the exemptions. But that's not, again, I would try to exhaust other options
Yes.
before they go that direction.
Agreed.
So here, any other questions? So here's the issue, unfortunately, with 401k loans is that if you leave that employer, you typically will have to pay that loan back immediately. So just be mindful. Sometimes employers will say, hey, you can keep the 401k here for a little bit, but plan administrators will typically find out active employees. And if they see a terminated employee or not active, then they may force you to close out that 401k or move it. And if you have a loan, you could be hit with the money that you took out. Any questions on that? So this came up from Sean a few weeks ago. A client had an annuity. Annuities are usually, they're a qualified recommendation, qualified plan recommendation. Annuities are great for deferring taxes, for guaranteed income stream in the future. Some annuities are based on an index, like an S&P 500. Some are based on variable mutual funds, and some are based on fixed annuities. Fixed annuities, you transfer all the risk to an insurance company, and they typically pay you an income stream. If a client has a fixed annuity, they probably have very little liquidity options, but if they have an index or variable, they may be able to get to their money pretty easily.
And that's for funds down, or I had talked to you about being able to use that for income. So for people that are of retirement age where they don't have to pay any penalties, they can pull it out of an annuity, IRA, 401k if they're of the age. And we can, and if there's enough in there to continue for 36 months, we can use that for income.
Yeah, correct. So if you even have like between any of these, an index, a variable, or a fix, but some of these insurance companies would say, hey, Sean, you gave us $100,000. We're going to give you 8% annually for the rest of your life. So, okay, now this is generating $8,000 of income a year. So yes, you could use that. Even if you don't turn it on, we can do an annuity exclusion calculation that just says, hey, if you did turn it on, this could be the potential income you could have. And then here's the net income versus taxes. So it's an easy calculation to do, even if they haven't turned on that income stream.
Are the withdrawal ages for IRAs, 401ks, annuities, where you're not penalized, are the ages all the same, like 59 and a half?
That is correct. However, there is something called substantially equal periodic payments, SEEP. And then, so even if you're under the age of 59 and a half, you can start taking income out from your 401k, annuity, from your 401k, any type of qualified plan without getting hit with a 10% penalty fee, as long as that's an equal distribution. So the money withdrawn is penalty free through annual distributions for a period of 5 years or until the account holder turns 59 and a half, whichever comes later. So if they turn it on at 55 or even 50, they could potentially not have a 10% penalty fee, and then you could use that as income stream as well.
What would be the purpose of someone doing a SEEP or SEP account?
Because they want it. So here's the exact situation. We had a client that was 57, and he's 57 now. He lost his job. He's got, let's say he's got $1 million in his 401k or his IRA with us. And he goes, hey, I need to get the money because I need to turn on my kind of financial independence, my retirement lifestyle, but I'm not 59 and a half or older. I don't want to get hit with 10% penalty fee. It's like, okay, well, Joe Bob, here's what we're going to do. We're going to start taking $30,000 out or $50,000 out on an annual basis. And we're going to take it as an equal distribution until you hit the age of 60, roughly 59 and a half. And by doing that, since we elected that option, he does not have that 10% penalty fee. So it's just really the option. It's the way to get some money early without having to pay that IRS fee.
Adam, will you hit on the backdoor IRA that you told me about that I had never heard from anybody else, for people that are making over a certain income limit?
Yeah, sure thing. So IRAs, Roth IRAs, we love Roth IRAs. Historically, taxes are very, very low right now. And if they go up, it's a nice option to eliminate that variable, right? To be able to eliminate Uncle Sam for decades and decades is awesome. So depending on your age, depending on your income, it may not be right for you, but we love Roth IRAs, Roth 401ks, Roth SEPs. There's a lot of Roths now for retirement plans that have changed the last couple of years. So in a traditional or in a Roth IRA, you can put $7,000 a year into it. But what if you have a 401k at work and you're maxing it out and you want to put more in, and you're married or single and you make over these amounts, 161,000 a year of modified adjusted gross income? If you're single, 161 plus, or if you're married, 240 plus. Well, let's say you're making $300,000-$400,000 and you do want to contribute to a Roth IRA. You typically can't do that unless you do what is called a backdoor Roth conversion. It's a loophole that's been around since 2011. So it's been around for a decade plus now, but there's a way that you can contribute that, let's say, lump sum of $7,000 into a traditional IRA, but you do not take the deduction. So it's a post-tax contribution. And then you immediately convert it to a Roth IRA. And it's just it's a traditional IRA conversion to a Roth, and there's no income limits on that. So it's a great way to get money in for you and your spouse. So potentially $14,000 a year if you're under the age of 50. If you're over the age of 50, you can do another $1,000 each. But $14,000 to $16,000 a year into a Roth IRA, even if you're making $1 million a year.
Awesome. And will you touch on that, the annuity that you set me up with a couple years ago, where you have the buffer?
Yeah, good question. So the market in 2022, and when I say market, I usually use the S&P 500 as that benchmark or that parameter. So the market in 2022 went down 18%. Last year was up 22%. It's up 3% this year, right? So there's always going to be ebbs and flow in the market. The market's going to go up, down, sideways, and in circles. It's just a matter of when do you need to get the money if it's in, let's say, one of these retirement accounts. And if you retire at the beginning of 2022, that can suck because you just took a pretty huge hit on your investment. So there's companies out there, we use two. One is Lincoln and the other one is Transamerica. And they offer what is called a hedging technique or a buffer. It's usually a 6-year hold, and you can put money into this S&P 500, this index annuity, and then over a 6-year period, they will protect anywhere from 20 to 30% downside, but then they'll give you the upside of whatever the S&P 500 is. There used to be a cap of 150%, and now there's no cap. But I don't think the market as the S&P 500 is going to go up more than even 150% over 6 years. So clients like that for predictability, for sleeping better at night, knowing that 20 to 30% of their value is going to be protected over a 6-year period. And there's no fees to that annuity too. So everyone likes zero fees. The downside, potential downside of that buffered annuity is that you have to hold it for 6 years. If it's in some type of retirement account, that may not matter. But if it's not in a retirement account, that typically just knowing you're going to lose some access to that could be a downside.
So if the market was down 22% and you had a 20% buffer, you only lose 2%. The market's down 18%, you don't lose anything.
That is correct.
Yeah, I thought that was a pretty awesome one, especially with how volatile the market was in 2022.
Yeah, and no fees. It's like, that's a no-brainer, right? Because annuities can be usually, not want to say usually, but they can potentially be high fees. We've seen some annuities that are 3.5% annualized fee. Not that there's anything wrong with that if you're getting the benefit in some way. Just be mindful that annuities can carry high fees sometimes.
Thanks for hitting on those. And we got a couple minutes here. If there's anything else you want to hit on, and
Yeah, the other thing too is solo 401ks are pretty attractive. You can get up to 23,000, or if you match to yourself, you can actually get up to $69,000, and it could be tax deductible as a traditional. And then a SEP IRA, very similar. You get up to 66,000 into some retirement account on an annual basis, and it's nice because you can reduce your income quite a bit.
so we have a lot of agents on the call here that are self-employed. So they can contribute more to a SEP plan when they're self-employed than you can, like for me being a W-2 employee to my 401k.
That is depending on their income, but yes, that is correct.
Awesome.
Hey, I have a question for you, Adam. John Jones here.
Hey, John.
I guess some advice, like, we see a lot of people that are, not quite at retirement age, or, let's say they're, 10, 15 years out, and they're looking, they potentially can purchase a home, they sell something out of state, they come to Florida and they want to pay cash, right? Because it's easy. And they see interest rates are high, but then when we might look at it and they decide whether to get a mortgage or pay cash, right? They can do both. What advice do you have for somebody that doesn't have necessarily like a lot of retirement assets that we can at least see, but they feel like, hey, I want to be like essentially like cash, house rich, cash poor type of thing? Do you like, from our perspective, sometimes we can see like, hey, this guy's only got 80 or 100,000 in savings. He's 58 years old, but he wants to buy a house cash 400. I mean, they need to have an outlet like coming to you, right? To get better advice about like maybe only put 20% down, utilize, put, 300. Let me show you what I can do in, the next 10, 20 years with 300 cash.
Yeah,
Like,
I mean,
I think that's an
know better.
opportunity that we run across, that like where people just generally want to use the, max out some of their cash with no savings.
Yeah, I mean, you guys know better than I do. Even mortgage rates now are still below the average over the last 30 years, even though they've been slightly higher the last few years. But it's still somewhat inexpensive to borrow money. What we don't like when people use all their assets and their cash to go buy a home is that they lose liquidity. It's very difficult to get to cash if you don't have a mortgage on your home. You have to do a HELOC, which may come with
They end up basically utilizing a reverse mortgage when they're 62, and that's what we want to all avoid, right? I mean, there's a better option with an annuity, right, that you guys can structure for them and show them how they can set themselves up better.
Yeah, and you could even do an annuity that I mentioned earlier that generates an income stream, but you still have access to the big bucket of money. That would not be a fixed annuity, but there's an option to do that. So a lot of times when people want to pay cash for their house, it's an emotional, personal decision. So we try to counsel and give guidance and remove those emotions and say, what's the financial best decision and what are the variables that could happen in the future? And if you don't have access to cash, well, that can limit and pigeonhole someone into making a bad decision.
Cool, thank you.
Does anybody else have any questions?
Adam, talk a little bit about how easy it is for someone to use assets to use his income and curb that DTI, debt to income ratio for qualification purposes.
Yeah, I mean, you guys may know better now from the calculation of debt to income, but if they have any type of using those exemptions or using some of those strategies that they have money in retirement accounts, we can utilize that. We can also utilize, if they have any investments, we can say, hey, listen, here's the income stream. We would typically pull a percentage for retirees. So if they have 100 grand, maybe it's easy to say we can pull 8 to 10% off of this the way it's invested. And then show that, listen, there's $8,000 to $10,000 from just that tranche of money.
Now, if we want to get like a distribution letter, so you got an account, like an IRA account set up for somebody, and we want to, like, let's say we need $5,000 a month for income, to qualify. So that they would need 5,000 times 36 months. They would need at least 180,000 in that IRA account to count 5,000 a month. If they had like 160,000 in there, well, then we divide the 160,000 by 36, they give us 4,400 a month. Would the borrower just contact you as their financial advisor, or would they contact, like if you had it with Franklin Templeton or Mass Mutual, who do they contact to get that distribution letter?
Well, if they're a client of Taylor Financial, they would contact us directly. And
Okay.
then whatever institution we may have that invested in, well, then we can pull that. So we're a digital practice. We're very quick on response. We're very quick on just PDFs and getting that to you. And Sean can probably echo that. So we're high service, high touch. And then since we're comprehensive, we use all these different companies. So it's very easy to get the information that you may need.
Yeah, I've had to
Or if they
borrow
don't
that.
have a company, right? I mean, if they just have their money sitting in cash or checking or savings, right? They can, bring that over to you, as your advisor, right? Yeah.
Yeah, have them call us, and maybe we can make them a client in some way, and then we can get the documents that the loan whoever needs.
Well, awesome. I appreciate you joining us. Thank you very much. We'll have you on again in the future. So
Thanks for having me.
yeah, appreciate all the advice. Thank you for everybody joining the call here.